FarmSense presents Profitability. FarmSense, helping agricultural economics make sense. A lot of people confuse revenue and profit. While closely related, they are not the same thing. So, what is total revenue? Let's start with an example. We have cows out in a pasture and they have calves. The time comes to wean the calves. We put the cows in a separate pasture and we take the calves, maybe also a cull cow, to market. When they are sold, we earn revenue. But that doesn't necessarily mean that we turned a profit. Revenue equals sale of product. So, we still have cattle in our pasture, but what did we do to produce cows? We have to have inputs to produce. What is total cost? Inputs include feed, supplement or grain, water, cattle purchase price, pasture, etc. All inputs sum in total cost. Some of these inputs, however, are fixed costs. What is fixed cost? Fixed cost is made up of fees that do not change. Even if we didn't have cows and didn't have to feed them, we'd still have some expense or fixed cost. If I own property, even with no cows on it, I still pay for its value. So, fixed cost cannot be changed by producing or not producing. What is variable cost? Variable cost is the opposite of fixed in that it fluctuates. This includes all of our feed inputs, which are prone to price fluctuation from season to season, as well as sick, dying, or dead cattle. Variable costs are associated with productivity, and they are bound to change or vary. So, to review, total cost is made up of both fixed cost and variable cost. Understanding total cost is essential in understanding and increasing total profit. What is total profit? Profit is not solely related to revenue, but is equally related to cost. Both cost and revenue may increase or decrease from year to year, but their relationship always impacts profit. Total revenue, that is all earnings, minus total costs, which is all fees tied to production expenses, equals total profit, which is what goes in your pocket after all sales are made and all expenses paid. Let's look at another example. In year 1, we purchase the input of corn feed, create a moderate revenue at market, and we see a fair profit. The next year, we increase costs by purchasing more feed, but our production does not see an increase, thus lowering revenue, and ultimately, this reduces yearly profit. Knowing this, in the third and final year, we are able to increase feed costs only marginally in comparison to year 2. After 2 years of increased feed, we see an increase in production and revenue, which then sees us our largest profit yet. By understanding the relationships between cost, revenue, and profit, we are able to better control our operation and predict future circumstances and profitability. Always remember, revenue and cost are in an eternal battle. If cost increases, revenue must also increase at least the same amount in order to achieve profit. These concepts can seem simple, but the relationships between profit, cost, and revenue are vital in maintaining balance in business and managing good, profitable decisions.